Hello, everyone, and happy Saturday to all of you. And thank you for taking the time out to come to this educational presentation. Now, today I want to talk to you about a four-step process to achieving consistent setups. And this can be applied to any strategy, any method you have that you're currently using. And we really feel it will increase your odds for consistency. Also, you can apply it to any market, any time frame. For example, I'm going to share with you a setup like this. This is an older chart in Adobe. And let's say that your strategy or method generated a buy signal right here, okay? Well, with the four components that I'm going to teach you today, you actually could have been able to determine that you would have exited right here with a 22.5-point gain just in about 2 or 3 weeks. It's going to be really simple. And like I said, you can start applying this as early as you like to any market, any time frame, and to any strategy or method that you're currently trading. So welcome, my name is Stephen Primo. I'm the president and founder of Specialist Trading. Thanks for joining us today. If you're new to my Saturday webinars, the main purpose of all of our webinars and of all of our courses is simply to educate traders. That's our real purpose. That's our goal, because we feel that the reason why most traders fail, it's been estimated upwards of 85%, is because basically, traders take themselves out of the game. I know I did when I first started trading 44 years ago. And by taking yourself out of the game, I basically mean that you're allowing someone or something else to make your trading decisions for you. Now, I know most of you will say, well, no, that's not true. I have a trading plan, or I have a system, or I have a process that I go through. But look at your process. Do you go to a trading room? Do you read a blog? Do you wait for the earnings reports to come out of the jobless claims? If you're relying on those things to help make your decision, you're basically taking yourself out of the game. And the reason I know this is because those are the exact same things I did when I first started trading 44 years ago. And as I always state, it didn't work for me 44 years ago. So why do you think it's about to miraculously start working now? The only traders I know that are consistently generating gains and that are still in the market are traders that make their own decisions. They don't watch TV or wait for earnings, or they don't read some blog or go to a chat room to find out what everyone else is doing. They have their own simple plan, process, and then they just follow it. Those are the ones that have been trading 20, 30, 40 years. So this is what I want to instill in all of my students. So if you've come here today thinking I'm going to tell you what I think the market's going to do, is it going to keep going up, or has it topped out, or what I'm going to tell you what the best stock is to buy for next week, you've come to the wrong place, because once again, that would be doing you a disservice. I would be taking you out of the game. And actually, I don't have any idea what the market's going to do. I don't know what the best stock is to trade or whatever. It's basically up for you to decide those things. So I'll try to instill in you the same things that were taught to me. Now, before we begin, as always, we're required by law to share this with you. So please take a moment to view our disclaimer. I'm going to share with you a lot of performance results using this four-step technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Also, please remember, since we are first and foremost an educational company, all of the examples you're about to see are firstly and foremostly for educational purposes only. Now, a lot of people are always asking us, well, how can we follow you to get more information on a daily basis? Well, the best thing is to follow us on Twitter. There's our handle right there, abbreviation for Specialist Trading. Every day I post different information, even though, like I said, we don't predict or forecast what you should buy or sell. We give you little snapshots of signals that our strategies have generated, and a little bit of information and education as to why they were generated. Also, we give you little bits of financial wisdom along the way. So please feel free to follow us on Twitter. There's lots of great free education on a daily basis. Now, remember, once we start today, I just want you to really focus, because as I said in the beginning of the presentation, this is an educational class. So the presentation slides I'm going to be sharing with you today are not that recent, but today we're not going to be talking about a full-fledged technique or strategy that has generated consistent gains over the past month. We're just going to be talking about something that you can start applying. And no matter how old these slides are that you're going to be viewing, these things are really consistent, and they've stood the test of time. So they're really for educational purposes only. So once again, my goal as an educator is not to force feed you signals, is not to tell you what I think the market's going to do, but simply to teach you how to trade with the specialist edge. This is the same edge that was taught to me some 4 decades ago. Hopefully it will be able to sustain you that same amount of time, okay? Now remember, this is a classroom. So like any classroom, I want you to ask me as many questions, but let's just wait till the very end of class to ask. I have a lot of slides here to share with you, and I promise I will wait till the end to answer the questions, but I will answer each and every one of them. The only question I will answer right now is the most common, and that is this being recorded? Yes, it is. So if you're having technical issues, I know we're new to Zoom, so we've had some technical issues in the past. If you're having technical issues, don't worry, everything is recorded. We will send you a link to this recording. The only other announcement I'd like to make is, since this is not an interactive class, meaning that we're going to be talking back and forth to each other during the presentation, please disable all your microphones and your cameras, okay? This is simply a static PowerPoint presentation. All right, with that stated then, let's begin today's class, and we're going to be talking about this process that I want to share with you. Remember, you can apply this to any market and any time frame. Now, with today's increased volatility, trading has a high potential for consistency. I know most traders think the opposite. They'll say to themselves, well, wow, the markets are really volatile. There's a lot of movement, crazy movement going back and forth. It's kind of scary. Actually, it's the opposite. This is where there are a lot of opportunities to take advantage of. So in order to be consistent, you must first apply this 4-step process. And the process details asking yourself specific questions. So these are the questions you must ask yourself before you pull the trigger. All right. These are extremely important. And like I said, it really doesn't matter what market or what time frame you trade. All right. So here we go. Question number 1. Am I on the right side of the market? I know it seems kind of ridiculous, but most traders feel like, oh yeah, I'm on the right side of the market, but are you really? Think of it. Whenever you lose, it's not because you have a faulty strategy. It's not because you're trading the wrong market. Most of the time, it's because you're out of sync with the market. You're not on the right side. The market wants to go down and you decided to buy, right? The market wants to go up and you decided to sell. So it basically means you're on the wrong side of the overall trend. So how do we figure out if we're on the right side? Well, it's really simple. You can all start doing this as soon as we conclude today's presentation. As you look at this older chart in Adobe, let's say that we're looking at this chart and we say, well, there's absolutely no direction here. We're going up, we're going back down, and then we're going up again. Well, is there really no direction at all? Because what we want to do is apply the 50-period simple moving average. We call this the buy-sell line. And this will tell us if we're on the right side of the market. For example, if we got a sell signal and we see here that the price has closed for the majority of the time above the 50-period moving average, we're not going to take it. Why? Because it's telling us that the overall trend is up. If the majority of bars are closing and are above the 50-period moving average, the overall trend is up. Therefore, we don't want to be a seller. If we want to be on the right side of the market, we only want to identify and trade buy signals, okay? So let's say we want to buy right here if we trade just above that high or that dashed green line there, okay? So that's okay. We're on the right side of the market. Whatever our strategy is, we're okay. Which leads us to question number 2. Where do I place my initial stop? Now, this is funny because most traders don't usually ask themselves this question in the very beginning. They'll ask themselves once they're already in the trade, right? Or once you're seeing that things are going against you, to go, wow, I better think about where I'm going to get out here. Or maybe I'll just hold on and turn into a long-term investor. This is another reason why traders fail. But actually, before you even enter into the trade, you should find out, where am I going to get out if I'm wrong? This is extremely important because it's going to come into play on determining a number of other factors. So let's just talk about a generic stop placement level. Okay, now in our courses, in our classes, we have upwards of 7 different stop placements for different risk parameters and such. Let's just pick a very generic one, okay? So as we look back here, if we're willing to buy at this area, our most basic stop should be at the most recent low. And the most recent low was right here, right? In other words, we came down, we made a low, and then we bounced up, kind of like a V pattern right here. So this would be a very generic place to place a stop. So let's just say that's where we're going to get out if we're wrong. So we're willing to buy here. And if the trade is wrong, we'll get out right here. Okay. So this brings us to question number 3. What is my profit target? We already know where we're going to get out if we're wrong, but what's my profit target? Where do I get out if I'm right? Because once again, most traders don't decide this prior to the trade. They're already thinking about this once they're in the trade. They're going, wow, this is going really great, but where do I get out? Do I stay in for the long haul? Maybe, I'm going to really have a big hit here, or maybe I get out before it turns around. You see, you never want to be in mid-flight wondering how you're going to land the plane, okay? You never want to be, in any predicament, rowing your boat down the river and figuring out, well, I'll figure out how to, maneuver through the rapids once I get there. You have to know this in advance. It's no different with trading. Here's the good news. We already figured out where our stop is going to be. So what you want to do is figure out if we're going to be buying here and if we're going to be exiting here, what are the amount of points I'm going to be risking? And that comes out to 11.25 points. So right off the bat, you can say, well, wow, that's a little bit too much. That's too rich for my blood. I can't risk 11 or so more points with my account size. So you can tell yourself, okay, then I'll axe the trade. I'm not going to trade it. Or if it's okay with you, if you don't mind trading an odd lot or a small amount of shares, you can say, sure, that's okay for me to trade. So we know we're willing to risk 11.25 points, however big our size is going to be on our trade. So this is going to be a very important factor because it's going to come into play as to where we want to exit. Now, a very generic, once again, standard way of exiting, this is trading 101, is to make at least twice what you're risking. Therefore, over time, you'll be a consistent, successful trader because even if you have a series of losses, you'll most likely make it back in the short run because you'll be making twice of what you risk. So if we're risking 11.25 points, then obviously we want to double that. Doubling that would mean we would be making 22.5 points. So that's our exit level. That's our profit target. And that would come out to 247, depending upon where we bought there. So you know this is where you're going to be exiting at 247. You'll make twice the amount of what you're risking if perchance you happen to lose on the trade. Which brings us to the 4th and final question. How do I protect my profits? Because once we're in the trade, we've all been there, right? We're having a good trade, we're making money, but we're starting to get scared, right? We're not exiting yet, and you're starting to get a little doubtful, and you're saying, well, I'm not sure if it's going to get all the way up there, and I don't want to have this trade. I have a nice little profit right now, but I don't want to see it turn into a loss. So how do we protect that? Okay. Well, our entry point would be right here once we trade above this bar at 224.5. All right, so what we want to do is measure the distance from here to here. We know that's 22.5 points. So at the halfway point, which is right here, the 50% level, we are going to move our stop to unchanged. So this means if price comes up to this half point level, half the distance, that means we'll move our stop up here. And that means if it runs out of gas, if momentum leaves and it turns right around and goes down, we won't lose anything. This is how you're protecting yourself. These are very important factors for adding structure to whatever strategy you're trading, whatever market, whatever time frame. So let's see how the trade unfolded. Well, we didn't trade at 224.50 yet, but then we did on the very next bar. So now we're in the trade. We have our stop down here. We've placed our limit order to exit up here. So we're all in control, right? We have structure. We've placed some binders on the trade, our entry, and then we have our exit for a profit and our exit for a loss. Now, we just simply watch. And as the trade is unfolding, it's starting to go in our direction. It's looking even better. And right now, we've touched and even crossed that 50% threshold. So what does that tell us? We've come halfway to our exit level. So we want to move our stop to the entry price. This means if all of a sudden some terrible news comes out, some worldly event, or just something happens where the trend changes, we won't lose any money. Remember, you've always got to protect a profit. You don't want to just sit there. How many times have you had a nice gain, whether you've sold short or went long, and then a week or so later you say to yourself, wow, I gave it all back and now I'm in the loss column. Now I'm losing money. It's the worst feeling in the world, right? Most traders, myself included, I would rather get into a trade and know that I immediately lost than get into a trade, have a nice profit, and then see that I've given it all back and now I'm in the loss column. It's a terrible feeling because you knew you had a profit. Well, by adding this simple technique of the 50% rule, you move your stop to your entry price, and at least the worst that can happen is that you'll break even. So what's left? Well, now the only thing left to do is to simply watch the trade unfold. I've said this many times, if you are trading correctly, if you are doing it right, trading is extremely boring. That's your signal. That's your warning that you're actually trading correctly. But if you're trading incorrectly, if you're really out of sync, if you're really more of a gambler than a trader, you've got a lot of commotion going on, okay? You see your profit and losses going up. You're up one day, down the next day. You've got tons of screens. You've got the phones ringing. You've got the TVs on, and trading is chaotic, all right? Well, if you're doing it that way, you're really not trading. You're just gambling. And there's nothing wrong with that. But you just have to be aware that that's not a trader's mentality. That's a gambling mentality. But if you're trading correctly, if you have structure, if you have guidelines, benchmarks, it's extremely boring. It's like you've gone out on the boat, you've cast your line, and you just sit and wait. You may wait for 15 minutes, you may wait for a couple of hours, maybe the entire day, and not get a nibble. But that's what trading is like. So ask yourself, what is your trading like? Is it crazy? Is it hectic? Is it chaotic? Or is it very calm and relaxed and you're just kind of sitting and waiting half the time? If you're sitting and waiting, in my opinion, you're trading correctly. So let's see how the trade unfolded, okay? All right, so we crossed the 50 threshold. Now, one thing I want to mention is that that 50 threshold is not written in stone. In other words, it does not mean that, well, you know, we're a half point away. That means I can't take my stop up to unchanged until it trades exactly at that half point number. No, this is discretionary. If you feel it's gone far enough, if it's gone 48.5%, then by all means, it's up to you. You can move it to unchanged. It's 50% level is just a guideline. It's a benchmark, but it's not written in stone, okay? Okay, so we've reached it. We've surpassed the 50% level, and we watch the trade unfold. This is where it's like fishing. You're just sitting, you're doing nothing. It's very basic. Now the trade is starting to come against you. Now you've given away some of your profit. Are you worried? Are you scared? No, you're just sitting and waiting. You've taken the emotion out because you're covered. The worst you can do is break even. And as you sit and wait, ultimately the trade starts to go back in your direction. And there you are. You exit with a 22.5 point gain. You made twice as much as you were risking. In fact, at the 50% level, you weren't risking anything at all. So this is a perfect scenario of what you want to achieve: consistency in trading. And remember, it's not the strategy that we're talking about today. We're not talking about rules on how your system generates a buy or a sell signal. Whatever you want to use is fine. But once you do that, you have to realize these 4 questions that you have to ask yourself, okay? Now, how many times have you seen a trade like this happen and you're feeling really good, and then you say to yourself, oh, I'm giving a lot of it back, I better get out, and you sell and it goes right back up? This is what will give you the confidence to stay in. Remember, once you get to the, or roughly close to the 50% threshold, you're not risking anything. So, you know, feel free to look at other trades. All right, let's look at another example. Once again, now this time we're going to be looking to the downside. All right, here's an Nolan chart in Fissler FSLR. Okay, let's say your analysis says, wow, I really want to buy this because look at, we broke that downtrend, that short-term downtrend, and we closed above. And that chat room I go to on a daily basis, or that blog I read, says you got to really buy this, all right? Because this is going to take off. It's probably going to go back at least up to these highs or make new highs. So this is technical analysis 101. We broke a downtrend. You got to buy it. The company looks good. They've been talking about it a lot on TV. So I really like this. You know, I'm going to buy this. You see how every decision I made, all my justification for buying this was based on someone or something else telling me that this is going to go up. Remember, what is the market telling us? Are we on the right side first? That's the first thing we have to figure out. So if you think you're going to buy here and place your stop here, you got it all figured out. Let's see what the market says. So question number 1, remember, always ask yourself before you trade, am I on the right side of the market. So let's add the 50-period moving average. We call our buy-sell line. All you have to do is just plot it. And remember, this could be a 5-minute chart, could be a monthly chart. It makes no difference. You always want a 50-period moving average plotted. And then ask yourself, where is price in relation to that? Price is below. Now, originally, price was above, right? It stayed up there for about 5 or 6 bars, and then it went below. So now we should only be looking at this from a seller's perspective. Now, it doesn't mean we sell at the market. We have to add some structure in the form of a strategy, but all signals should be from a seller's point of view and not from a buyer's. Why? Because we're putting the odds in our favor. Remember, this is going to increase our odds for a consistent setup. That's the title of today's presentation. So we want to have consistent setups. So the first way to do that is to be on the right side. Now go back and look at your last 10, 20 trades. I can almost guarantee you that the reason why you had losers is because you were out of sync. You were on the wrong side. Remember, the first rule is to want what the market wants. And this is how the 50-period simple moving average can help you. All right. So we're not on the right side. So we should in no way be taking a buy signal. And look what happens. Had you bought that, you would have automatically been in the losing column and you would have scared yourself and said, gosh, did I make a bad decision here? Whereas if you use the 50-period moving average in the first question you ask yourself, you wouldn't have lost anything because you wouldn't have been in the trade. Now, looking at this now, you start to say to yourself, well, you know what? My strategy or another technique I trade is generating a sell signal based on that last bar. So you want to sell according to your strategy if we trade just below that bar. Okay, you're in sync. You're on the right side of the market. There's no guarantee this is going to work out, but at least you've put the odds in your favor because you're on the right side, which leads us now to question number 2. If you're wrong, where do you place your initial stop? Okay, because remember, we never know if something's going to work out. Doesn't matter. You can go back and back test your method 10, 20 years. In fact, I used to teach systems for another company that shall remain nameless, where we had back tests going back 10, 20 years with phenomenal results, phenomenal statistics. And then when the market changed drastically, all those statistics went out the window. They went down the drain. Nothing worked. They gave everything back. So that's why we don't rely on numbers or stats at specialist trading, because we know that once the market changes its environment, anything can happen. And so how important are these statistics if they just all blow up in a matter of months when the market changes? What we rely on is just listening to the market and trying to be in sync with the market. So the first thing you want to do is see if you're on the right side. The second thing you want to do is ask yourself, where do I place my initial stop? Because remember, you could be wrong. So we're just going to use that same principle we used earlier, looking at the last short-term high in this case. So if we're looking for a short-term high, this would be a little bit too close to the vest here. Let's go back all the way back here. This was the short-term high right here. So we would initially place our stop up here. If we traded at these levels, this is where, once again, we would get out. Now, once again, I see some people are joining us and using their cameras. Please disable all cameras and microphones. Remember, this is not a live presentation or an interactive presentation. Okay, so let's see here. See if I can do that for you. Okay. So we're going to exit right here. If this is, where we're going to be wrong, let's give ourselves all this room. We sell here, and this is where we'll get out. Okay. So this now brings us to the third question. Question number 3. What is my profit target? We already know where we're going to get out if we're wrong. But where do we get out if we have a profit? We're shorting now. We're selling short. So where do we get if we have a profit? Remember, most traders decide this kind of as the trade unfolds. Do the same thing with stop levels. Okay. The most important thing to most, inexperienced traders is where do I get? I want to buy. Where do I sell? And then once they're in the trade, it's like, what do I do now? You should never ask yourself that question. What do I do now? I mean, that's the sign of an inexperienced amateur trader. A real trader knows everything even before he or she enters into the trade. That's the sign of an advanced trader. You know where everything is about to happen, where you'll be with a winning trade, where you'll be with a losing trade, where you'll move your stop to unchanged. All of these are all figured out prior to even entering. That's the sign that you're on your road to being a professional trader. So you have to ask this even before you enter the trade, what is my profit target? So this is determined by where we're going to be getting out if we're wrong. So remember, if we entered here and we exit here with a loss, how many points are we going to be risking? Well, that comes out to, oops, went back there. That comes out to 8.20 points. So you have to ask yourself, even before you get into the trade, am I willing to risk 8.20 points? If you say to yourself, no, it's a little bit too much, then don't take the trade. But if you say, hey, I have more than enough to cover that. In fact, I can buy a little bit more. Well, then fine. But that's how much you're risking, 8.20 points. So as we said earlier, a lot of traders like to rely on risk-reward ratios, meaning that they want to at least double whatever they're risking. So if you're risking 8.20 points, you want to make at least double that. This will ensure another level of consistency. So you subtract 16.5 points from where you would be entering, because 16.5 is 8.20 times 2. It's double. So you want to make twice what you're risking. Twice 8.20 is 16.40. So you subtract that from your entry point, which would be 67.55, and here is your exit at 51.15. See, it's all very simple. And I know I'm taking a good half hour, 45 minutes to explain this, but once you get the hang of it, you'll be able to calculate all these things in probably less than 30 seconds. It's really easy. Figure out where you want to get in, where am I getting out if I'm wrong, double that amount of points. Here's where I'm getting out at the exit. What's the halfway point? I'm okay. All right, I got it all figured out. So here's your exit at 51.15. You'll go short at 67.55. Now, question number 4, and the fourth and final question, how do I protect my profits? What if it starts to go in your direction and you're having a nice, profitable trade? You start to get a little scared there. You say, wow, what if everything turns around? What if some good news comes out and the market shoots straight up and now I've got a loss? Well, measure the distance from where you entered to where you want to get out and cut it in half. That's the 50% threshold. So once price gets close to here or touches here, this is where you want to move your stop to unchanged. This is meaning that if price only comes down to this level and then turns around, well, at least you'll break even. Excuse me. It means you won't risk anything. All right, let's watch the trade unfold. Well, you went short, it's going in your direction. Wow, now you have a really good profit. Should I get out? Well, I mean, you're always free to do whatever you want, but if you're sticking to the plan or process, you can still stay in the trade. And at this point, 3 days later, you've already reached the 50% threshold. So what do we want to do? We want to protect the trade because we know that anything can happen. We can all of a sudden turn around and go straight up. And what does this mean? Well, this means that we could lose everything. So what we want to do is move the stop to the entry price right here, okay? So what we're doing is we're protecting our trade. So if the worst case scenario happens and all of a sudden the market goes straight up, what's going to happen? We're just going to break even. We're not going to lose anything. So let's see what happens. Let's follow the trade. Remember, the only thing left to do is to watch and the trade unfold, just to follow it. Remember, we're like fishermen, I should say. We're just sitting down, watching and gazing at the water, and it's extremely boring. We're just fishing right now, and we're just waiting. That's how you know you're doing it correctly. So as we can see here, we're going lower, and now we're starting to go much lower, and ultimately we get to our exit point, and we have a nice profitable trade, okay? All right, let's review. What's the process we just shared with you that you can apply to any strategy, any technique? All right, these are the 4 questions you must ask yourself prior to entry. The first one is, am I on the right side of the market? Why is this so important? Well, as I said earlier, one of the major reasons why you lose is because you're out of sync with the market. You're on the wrong side of the market. You are buying when you should be selling and vice versa. So you want to be on the right side. The easiest way to do that is to apply the 50-period simple moving average. And if price is above, well, then you're only going to be looking for buy signals. If price is below, you're only looking for sell signals. So let's say your strategy generates a buy signal, okay? If it's below the 50, you shouldn't take that trade because overall, over time, it will be an inconsistent setup and you will be out of sync with the market. Remember, every once in a while, you will get a good trade where it goes higher, even though the signal was below the 50, or a good sell signal that is above the 50. Remember, we're trying to instill consistency, as you see here in the title. And consistency is a two-step forward, one-step back approach. It's not about one trade. It's about a number of trades, all right, all together, collectively. So if you do this collectively, you'll have the odds in your favor. All right, this brings us to question number 2. Where do I place my initial stop? Remember, in our courses and all of our classes, we have upwards of 7 different stop placements. If you're someone who doesn't like to take a lot of risk, or if you're someone who doesn't mind taking a lot of risk, we have the stop placement for you. We also have stop placements that track the trade while you're in the trade. But just to place a very initial generic stop, if you're going long, just place it below the last short-term low. If you're going short, place it above the last short-term high. This is a very generic way to place your stop. And then figure out how many points that is that you're willing to risk. If it's too many points, if you're not going to be able to buy hardly any shares and it's just too risky for you, then don't take the trade. You don't have to take the trade. This is not a system where everyone must take the trade in order to reach these amazing statistics. That's not what trading is about. Trading is having you a part of the process, which means you have the freedom and the right to decide whether you want to trade it or not. All right. So you can decide that once you have your initial stop. Which brings us to question number 3. What is my profit target? Well, that's one of the main reasons why we determine what our stop is, because the stop is going to be half of what our profit target is. So in other words, if we're risking 5 points, our profit target must be twice that amount before we even exit. So we must get out with a 10-point gain. We want to make at least double what we risked. Okay, that is another high level of consistency that will, not ensure that you have a winning trade, but over time, if you have a, adequate enough method, you will be consistent because you'll be making twice the amount of what you're losing. And then lastly, how do I protect my profits? As we often stated in today's presentation, one of the worst feelings in the world is when you have a profitable trade and then some news comes out, right? Or something happens overnight around the world and all of a sudden the market crashes and you had a nice profit going and all of a sudden it's a loss now. And now you don't know where to get out and you're figuring like, boy, do I hold on to this? Should I buy more, double up? So using the 50% threshold, that means once you get half the distance to your exit or profit target, you simply move your stop to unchanged, meaning where you purchased. Now, remember, this does not mean that it's written in stone that it has to touch that exact number. This is probably one of the biggest questions I get from beginning students. They say, well, Steve, I missed it by 20 cents. Does that mean I can't do it? No, you're part of the process. This is what we said before. You're making your own decisions, not us. So if you feel it's come to a reasonable point, maybe 45% the distance and you feel comfortable, then that's fine. This is not a system. It's not something that we rely on that it has to be, black and white. There's no wavering from the rule. No, you're always free to change. Why? Because our philosophy is you are in charge. No one should ever tell you how you have to enter, how you have to exit. They should give you guidelines and things for you to work with, but ultimately it's your decision. So these are the 4 steps to consistency. Now, we have a great discount and a great offer for all of you taking time out of your Saturday morning to attend this presentation. We're going to offer you a great strategy that is built off of these 4 components. This is the first strategy I was taught by my mentors when I was struggling some 44 years ago. And they taught this to me on the floor of the Pacific Stock Exchange. That's where I first started working. And I still continue to use this in some capacity today. This is strategy number 4. Now, pay no attention to the graphic there where it says stock momentum trader, because when I first started teaching roughly a dozen years ago, we mainly geared the market of, my background was in stocks, mainly geared towards stocks. But through the years, we have found out that this method can be easily transferred onto E-minis, onto futures, onto currency pairs, onto commodities, onto Bitcoin. So it makes no difference. As you see on the bottom, it works on all markets and on all time frames. So I don't want you to think that, well, Steve, I don't really trade stocks, I trade Bitcoin, or I trade the forex markets. We have dozens, if not hundreds, of students around the world trading in various markets, okay? Now, with this course, you're going to get detailed instruction. All right. Now, the instruction is through our video courses, but you're going to learn all the different entries, all the different exits, and all the different stop places. Remember, our job as an educator is to provide you with this information so that ultimately you can make your decision as to how you want to enter, how you want to exit, how you want to place your stop. And then you can still apply that process, but according to where you entered and according to where your stop is. So you'll get educational signal alerts. These will highlight exactly where the signals have been generated. This includes the add-ons. You can add them onto your current platform. Most of the major platforms such as TradeStation, Metastock, MT4, Sierra Charts, Thinkorswim, through a NinjaTrader, lots of different ways to find that. Okay, now here's one thing I want to share with you, some recent strategy number 4 signals, because everything I taught you today is incorporated within strategy number 4. Here's a setup in NXPI, okay, semiconductors. This was just on the 20th of August. A buy signal was generated right here. Stock went up 15 points coming into, I believe this was just Friday, this week or Thursday. Yeah. So this was an actual signal using strategy number 4 that our students were able to take advantage of. Here's another one. This is in DraftKings, a sell signal right here, 20 points to the downside, okay? Now, just to show you that it doesn't have to always be applied to stocks, here is a chart of the Euro Swiss franc. Another sell signal was generated using strategy number 4. Euro Swiss franc fell over 100 pips in the next less than a week. That's $1,000 per unit. And then if we have Bitcoin traders here, this is the first week in August. 2 strategy number 4 signals were generated right next to each other. This is what we call a cluster setup because they clustered close together. This is a high probability signal. And as you can see, nearly 11,000 points coming into the last week in August right here. So these are all current examples using strategy number 4 in different markets. And remember, if you're an intraday trader, such as myself, I like to intraday trade E-mini futures, you can also apply it to intraday markets. So it makes no difference what market or what time frame. It's probably our most popular trading strategy among all our students around the world in over 115 countries and in every state in the United States. And as I stated, I use it every day in my own personal trading in some capacity. So let's break this down. We're going to offer you a great discount for strategy number 4. Remember, it comes with all the rules. You're going to get the add-ons to apply to your current platform. And it also comes with different entries, exits, and stop placement, okay? Normally, this would cost you $700, which in my opinion is still very inexpensive. I've seen some strategies and some methods out there for tens of thousands of dollars, and you know, I'm not even sure how good they work. This is the normal price is $700. Well, we're going to slash that by 50%. All right, we're only going to charge $347.50. That's a 50% discount. Now think of that. For less than $350, you can have a strategy that I've been trading for over 4 decades and continue to trade. And you don't have to get a different one for every market, every time frame. If you like to trade multiple markets and multiple time frames, you use the same rules. It's that easy to transfer onto all these different markets, okay? Now, the great thing about this is that 50%, I can almost guarantee that most of you lost more than $300 this last month trying to figure out what the market's going to do, right? Well, for that same price, you could have had over 4 decades of instruction here coming from the strategy number 4 course. So this is a great opportunity to turn your trading around. In fact, think of it. We only have 4 months left in the year. A year from today, you will have wished you became a member of the strategy number 4 course. So take advantage of this. This is a great offer. Like I said earlier, $695, in my opinion, is still tremendously inexpensive. But if you cut that in half for $347.50, I mean, you're getting such a bargain. So take advantage of this. Here's how to do that. Contact my sister site, Pro Trader Strategies. I developed the strategy with them and all the add-ons and all the course rules. You can email them, but I would probably say the best way to come on board is to call them directly at area code 310-598-6677. They have trading consultants manning the phones right now. They'd be more than happy to take your order over the phone, or even just to ask you any questions, answer any questions, I should say. You can ask them any question. Answer any question you had concerning pricing and concerning strategy number 4, the setups and using it on the platform, okay? Now, that link you see at the very bottom is the link that will take you to the information page. And if you'd like to sign up online, you can do that as well. but I've just posted a live link on the chat box because that link on the screen is not live. So if you click that on, nothing's going to happen. But if you go to the chat box right there, you'll see a link. It says protraderstrategies.com, Stephen Primo strategy number 4. Just click that on. It'll take you to the sign up page. And if you'd like to, you can sign up there or get more information. But if you have questions concerning pricing or discounts, I would really, don't hesitate to call 310-598-6677. Remember, there's absolutely no obligation. If you're not sure what you want to do yet, they're not going to try and coerce you into making a sale. They'll just give you some information about that, okay? Now, I promised I would reserve the last 10 or 15 minutes for any questions. If you have any, now's the time. Just go to your chat box and I will answer them to the best of my ability. Okay, a question here for stops. Do you use stops or stop limits? And would you please explain the difference and when to use each? Wow, okay. Well, remember, we're not a, I should say, we're not a brokerage firm. So to get the complete exact definition, what you want to do is go to your broker for this or go to some website, but I can just give you the generic explanations. First of all, when I say stops, this is a certain type of order that you use to get out. Usually you can use it in a number of different ways, but the way we're referring to it today is to stop your loss. In other words, if you buy at 50 and you want to get out at 45, that means you're going to stop losing. That's where I'm getting out. So I only want to lose 50 points. Now you have different type of stop loss orders. You can say the minute it touches my level, let's say 45 once again, it turns into a market order. Or you can say, you know what, the minute it touches there, it turns into a limit order, excuse me, and I have to get out at that exact level at 45. I don't want to risk any more, okay? I don't want it to touch there and then on some big gap down, I get out a point or two lower. So once again, our philosophy is it's up to you to decide. We're not, this is not a statistically, generated course here. A lot of our students swear by using stop limits. They say, no, I get out at the limit. That's where I get out. I love it. Whereas other students say, no, the best way to get out, because that way I'm just out of the market. So many times I've missed it by placing a stop limit and saying I have to get out at a certain price. So I use just a standard stop loss, which turns into a market order. So we can't say that one is right and one is wrong. The only way you can define that is through your personal research and research and looking back at trades, at paper trading, and then determining for yourself. Remember, our job as an educator is not to tell you exactly how to enter and exactly how to exit. It's to highlight high probability points. It's your job to decide that, okay? This is why we give you upwards of 6 or 7 different entry or exit points. Now, some people are saying there's a link error. If you can't open it up, all you have to do is copy and paste that on the very bottom there, or you can copy that down, that link, if there is a link error. Or like I said, the easiest thing to do with absolutely no obligation, don't feel worried that someone's going to try and sell you something. In fact, if they do, tell them Steve Primo said, you can't hold me to buying anything. I just had a question, okay? Because we don't want you to feel pressure. We're a small company. We just want you to learn. We're an educational company. So just call 310-598-6677 if the link isn't working for you, okay? Somebody's asking, can this strategy work on binary option trading? Yes, it can work on anything, but remember, the point is the results you're going to get is determined on how much you research and paper trade with our different guidelines and different options and variables to see what works for you. Remember, this is not statistically in any way generated because we don't believe in that. As I stated, I traded statistically generated systems for years and they all blew up in 2008. They had upwards of 20 years of phenomenal results. And in 2008, everything gave back all the money they had made and more. They all went belly up. So I don't believe in statistics. That everyone should trade according to their own means, okay? Question, when you get a cluster of even more than 2 strategy number 4 signals together, like 3 or 4 or more together, does this often create an even higher probability for successful trade? Or remember, there is no statistics or higher probability, but we have just seen, and what students have told us is that yes, it does. Now, it doesn't tell you which one of those signals is the best, because you'll get a cluster of maybe 3 or 4 signals, and it doesn't often say, oh, well, this one is better than the other one. But there is telling you that there are some real highly generated setups going on all at the same area. So our students have told us that yes, they do have high probability, but once again, this is up for our students to decide independently on their own. Remember, so much of trading is determining and figuring out for the very first time how you like to trade. Okay, I often tell this story to my students. When I first started teaching roughly about 15 years ago, I had a number of students who wanted to know exactly the way I traded. And I had a small class of about 5 students that got together just with me personally. This was before I even started specialist trading. And I showed them exactly what I did on a daily basis, okay? I showed them exactly how I determined what I was going to buy, where I was going to buy, where I was going to exit, and where I was going to place my stop. Exact same number. So everyone knew exactly the same rules, okay? Now this was for intraday trading because I'm intraday trading the E-mini futures. Now, 2 weeks after that course, I had done very well, extremely well, in fact. So I contacted all my students and everyone had different results. In fact, some students lost money. Some students broke even and some students made even more money than I did. And I couldn't understand. I said, how can we do this if we're all trading the same signals? And the reason is because I discovered the great truth in trading is that no two traders should ever trade alike because everyone comes in with different baggage. In other words, some of those students said, oh gosh, this risk is too crazy for me. I can't take the same amount of risk that Steve takes. So they would second guess themselves. They would try to buy it lower or sell higher just so they wouldn't have to risk so much. And they basically were altering the rules without any structure, just off discretion. And some of them lost, some of them didn't make any money. Whereas others didn't use the exit rules and they stayed in longer and maybe they made a little bit more money, maybe they lost more money. So everyone has different baggage, different risk parameters, different ways in which to trade. So I realized that no two traders should ever trade alike. But then I thought, well, then how do you come to the agreement within yourself of how you should be trading? And the way is through sound fundamental education. In other words, you should be provided with and equipped with a number of different scenarios for entries, for exits, for stop placements. And then you should be able to decide which ones make you feel comfortable. Because you will never, I don't care how profitable the system or method is, if you don't feel comfortable trading it, you will not make money. You will second guess yourself. You'll get in too late. You'll get out too late. You'll get in too early. You'll get out too early because you don't feel comfortable. So that's the great truth in trading. That's why we don't teach systems. Systems require everyone to trade the exact same way like robots. And systems, since they trade the exact same way, come up with statistics, but we don't believe in statistics. Remember, once again, think of 2008. I saw upwards of 10 different systems all blow up and go bust because none of them could change the market environment. So what really is important is that you're provided with different variables and then you decide. Think of a smorgasbord, okay? Think of a buffet table. Everyone is going to get the meal they want, right? But everyone picks a different meal. Someone may pick a different entree than the other person. Another person may just pick a salad, a chef salad. Another person may just want to go for the desserts. Either way, they're all going to be satisfied, but they have to pick what makes them feel comfortable. It's the same way with trading. You have to decide. You cannot let some guy on TV, someone in a chat room or trading room, or someone in a blog telling you what the market's going to do or what the best stock is to buy. That is a recipe for disaster in our opinion. So that's why we are first and foremost an educational company. So to come around to answering that question, Eric, I'm sorry I took so long, but when you see a cluster, yes, that's a really good sign, but is it statistically proven to be a higher probability than anything else? Actually, no, it all depends on the market you're trading and the time frame as well, okay? I hope that best answered your question, okay? Okay, any more questions? I hope you fully understand our philosophy and what we try to bring to you and what we try to really do to educate you. Because as I said, we are educators. We're not here to tell you what we think the market's going to do. I would be doing you a disservice if I did that. Someone is just asking what I mean by educational correspondence. I had that in the slide. Educational correspondence just means that you get my personal email address. So if you ever have a question about the strategy or about the techniques and you're not really sure how to apply it, all you have to do is email me. You can email me whenever you want. I was answering emails prior to this presentation today. by our students around the world. And remember, the emails come directly to me. They're my email address. They're not sent to some intern or some other person in the company. I see all the questions and I answer them personally myself. So that comes along with all of our courses. You get my personal email address, and it's like I'm there with you every step of the way, okay? Okay, if there are no further questions, thank you once again so much for taking time out of your Saturday. I hope you learned something. I would suggest start applying this process. Oops, got somebody on the microphone coming. Remember, disable all microphones. Someone's coming through. Okay, thank you so much. Remember, if you have a personal strategy that you feel the best, it works really well, I would really suggest adding these 4 components and seeing how they can really increase your consistency. I really think you'll be happy with it. And I think after you apply it, you'll say to yourself, wow, this really helped. Now, strategy number 4 is based completely on these components. So if you're interested in getting a method that's based on these 4 components that will really increase your odds for consistency, contact Pro Trader Strategies, call them directly, 310-598-6677, okay? As we look at one last disclaimer here, I just want to thanks for taking time out of your Saturday. I hope you have a great week following. I hope you can use these, and I wish you the best of luck of trading. But mostly, I look forward to all of you becoming students of mine with strategy number 4. Take advantage of that 50% discount, and I'll talk to you next time. Bye-bye.